Hey everyone, welcome back to the channel. We've got some big updates this week regarding the Federal Reserve and what it means for your investments, your savings, and just the broader market overall. So I wanted to break this down for you in real simple terms, because I've been seeing a lot of people very confused about what's going on with interest rates, risk assets, and basically what the Fed is planning for the next few years. And here's the big headline. The Federal Reserve is officially pausing any rate cuts until 2027. That's right, not next year, not 2025, not 2026. We're talking 2027. Now, I know a lot of people have been holding out hope for rate cuts to come sooner because you've got mortgages, credit cards, auto loans, you name it, that all depend on interest rates. And when rates go down, all of that gets cheaper. But according to the latest statements and projections, the Fed isn't planning to do that anytime soon. And before I go any further, let me just say this. I know a lot of viewers are already thinking, wait, what about my stocks, my crypto, my real estate investments? Am I about to get crushed? And I get it, okay? It's confusing, and there's a lot of noise out there. But I want to make sure you understand this completely, because there's a lot more nuance here than just the Fed isn't cutting rates. So first, let's break down exactly what the Fed is saying. The Federal Reserve recently released their projections, and they're signaling that interest rates are going to stay elevated for a while. When I say elevated, I mean higher than what we've seen in the last couple of decades. They are basically saying that even if the economy slows down, they're not going to start cutting rates until 2027. And this is part of a strategy to keep inflation under control. That's right, it's all about inflation. They want to make sure inflation doesn't come back roaring before they start thinking about lowering rates. Now, I want to pause here because this is really important. A lot of people don't understand the timeline here. They hear 2027 and they freak out. They think, oh my God, that's 4 or 5 years from now. My life is ruined. But here's the deal. The Fed uses these projections as a guideline. It's not a literal, we're locked in until 2027 statement. It's a forecast based on current economic data, inflation trends, and growth projections. So yes, it's likely rates will stay higher for a long time, but there's always room for adjustments if something unexpected happens. All right, now let's talk about risk assets, because this is where a lot of viewers get really concerned. Risk assets are basically anything in the market that can fluctuate a lot in value. Your stocks, your high-yield bonds, even crypto. And when interest rates stay high for longer than expected, risk assets generally come under pressure. Why? Because higher rates make borrowing more expensive, which can slow down company growth. It also makes safer assets like bonds more attractive, which can pull money out of stocks. I've been seeing a ton of comments from people saying, does this mean the stock market is going to crash? And honestly, that's the million-dollar question, right? No one knows for sure. But here's what I can tell you. When the Fed signals higher rates for longer, risk assets usually see more volatility. That doesn't necessarily mean a crash is guaranteed. What it does mean is you need to be prepared for some ups and downs. Now, I also want to address something that's been confusing a lot of people, and I've seen this in the comments over and over, which is the difference between the Fed's policy rate and your actual loan rates. Just because the Fed says they're keeping rates high doesn't mean your mortgage rate or your credit card APR instantly jumps or stays static. There's a bit of a lag. And also, the Fed's rates influence things like the federal funds rate, which banks use as a benchmark for lending, but individual rates can move differently. So don't panic thinking, oh my gosh, I'm going to pay double on my mortgage tomorrow. That's not exactly how it works. All right, moving on. Let's break down the timeline here, because this is something that's really important to understand. The Fed has made it clear that they are projecting no rate cuts until 2027, which is roughly a 5-year horizon. That doesn't mean rates can't fluctuate a little within that period. They might pause, they might hold steady, but they're signaling no aggressive cuts until later. And the reason they're doing this is that inflation, while it's come down from its peak, is still above the Fed's long-term target. So they're essentially saying, we want to make absolutely sure inflation stays under control before we think about easing policy. And let me just be honest with you, this is a strategy that has risks. Keeping rates high for this long can slow down economic growth. It can make loans more expensive. It can put pressure on households and businesses that rely on borrowing. But from the Fed's perspective, they're looking at the bigger picture. If inflation comes back, they don't want to be forced into a much harsher tightening cycle later. Now, I want to take a minute here to talk about different types of investors and how this might affect you. First, if you're a stock investor, particularly in growth stocks, tech stocks, or speculative sectors, higher rates for longer can be challenging. Growth stocks usually rely on future earnings, and when rates are high, those future earnings are discounted more, which can put downward pressure on prices. That doesn't mean all stocks are doomed, but it does mean you could see more volatility in the near term. If you're in bonds or fixed income investments, higher rates might actually be a silver lining. Why? Because new bonds are issued with higher yields, which means if you're buying now, you could lock in better returns. But if you already hold older bonds with lower rates, their market value could decrease. So it's a mixed bag, and it really depends on your strategy and when you plan to cash out. For those of you watching who are in real estate, this is another area where higher rates can make a big difference. Mortgage rates are heavily influenced by Fed policy and broader market yields. When rates are high, buying a home gets more expensive, and that can slow down the housing market. But again, this is all relative. It depends on location, demand, inventory, and other economic factors. Now, let's address something that I see a lot of people getting wrong in the comments. People are saying things like, if the Fed isn't cutting rates until 2027, then everything is going to collapse tomorrow. And that's just not accurate. Financial markets are forward-looking. Investors are constantly pricing in expectations. So even if the Fed hasn't cut rates yet, the market may have already adjusted to the idea of a long pause. That doesn't mean you won't see drops in certain sectors, but it also doesn't mean we're heading for a total meltdown. All right. Now, I also want to talk about the communication strategy of the Fed, because this is something that's often misunderstood. The Fed doesn't just make policy decisions in isolation. They communicate their expectations through statements, press conferences, and projections. And sometimes they send signals that seem contradictory or confusing. You might hear one official say one thing, another official say something slightly different, and it can feel like chaos. But what's happening is the Fed is constantly assessing data and trying to guide markets without causing panic. Now, you may have seen headlines this week that say things like, Fed pauses rate cuts, risk assets under pressure. That's true, but I want to explain what risk assets under pressure really means. It doesn't mean every single stock is going to fall off a cliff. It means that sectors that are sensitive to borrowing costs, like tech, high-growth companies, and leveraged investments, might see more volatility. Meanwhile, sectors that are more resilient to rates, like consumer staples or utilities, might hold up better. So it's not black and white, it's nuanced. Okay, here's another thing I want to make super clear because I see this question a lot. What this means for your personal finances. If you have debt, whether it's credit cards, personal loans, or a mortgage, higher rates for longer means you might be paying more in interest for a while. But if you're someone who's saving money, higher rates can be good news because you might get better yields on savings accounts, CDs, and other low-risk investments. So it really depends on your situation. Now, let's talk briefly about the Fed's reasoning behind this pause until 2027. It's all about inflation control, plain and simple. They want to make sure inflation stays at or below their 2% long-term target. They also want to avoid a situation where rates are cut too early, inflation picks back up, and they have to hike aggressively again. This is a long-term strategy, and while it might feel frustrating for some, it's meant to stabilize the economy over the next several years. I also want to touch on how this might impact different regions of the US, because not everyone is feeling the effects of rates the same way. Areas with higher debt loads, higher housing prices, or more leveraged companies might feel the impact more. Meanwhile, regions with stronger job growth or more resilient local economies might not feel as much pressure. So it's really important to understand that the Fed's policies are broad strokes, but the effects are often very local and specific. And one more thing before I play a couple of clips for you. I've been seeing a ton of comments asking, will this cause a recession? And here's the deal. The Fed isn't explicitly saying a recession is coming, but higher rates for longer can slow economic growth. That's why you'll see mixed opinions among economists and analysts. Some think this pause is necessary to avoid runaway inflation. Others worry it could tip the economy into a mild recession. The reality? Only time will tell. And that's why being prepared and understanding your personal financial situation is key. All right, now I want to play a quick clip from the latest Fed meeting so you can hear it directly from the source. I'm not going to play every single clip from every official. There are dozens of them. But this one is short, about 30 seconds, and it really highlights the Fed's stance on rates and the economic outlook. Here it is. Clip plays Fed Chair speaking about rate pause, inflation, and projections until 2027. Okay, now that you've heard that, let's break down what was said. The Fed Chair emphasized that they are committed to keeping inflation in check and that rates are projected to stay at current levels or slightly higher until 2027. They also acknowledged that while this might put pressure on risk assets, it's necessary to ensure long-term economic stability. And again, this is key. They are projecting, not guaranteeing. Plans could change depending on future data. Now, I also want to address the timeline here again because some of you might have missed it. Even though the Fed says no rate cuts until 2027, there could be minor adjustments along the way. They could pause, they could tweak rates up or down slightly, but the main point is that aggressive rate cuts aren't expected anytime soon. And finally, I want to give you some tips for navigating this environment. First, if you're invested in stocks, consider diversifying. Higher rates usually mean more volatility, so spreading your investments can help manage risk. Second, if you have debt, be mindful of interest rates and consider paying down high-interest loans. Third, if you're saving, take advantage of higher yields on safe investments like CDs and high-yield savings accounts. All right, everyone, I think that covers it. I could literally make a video every day breaking down Fed announcements because there's always something new and confusing, but I wanted to make this one clear and straightforward. So, in summary, the Fed is pausing rate cuts until 2027. Risk assets are under pressure, inflation control is the main reason, and your personal financial impact depends on your investments, debt, and savings. Keep an eye on developments, stay informed, and make sure you're prepared for volatility. That's it for today's update. Drop your comments down below if you've got questions, thoughts, or if you want me to dive into specific sectors or investment strategies in a future video. Don't forget to subscribe if you haven't yet, and share this video with anyone who's trying to figure out what's going on with the Fed, the markets, and risk assets. All right, everyone, thanks so much for watching. Stay tuned. I'll keep bringing updates as they happen. Until next time, take care, and I'll see you in the next video.